The relative and comparative strength of dollar is the only factor that the Federal Reserve cares about. This means that the strength of the dollar compared to other currencies is high, not that the actual strength of the dollar is high. As we all know, the actual strength of the dollar is cratering at its fastest rate in decades. This is more important to the Federal Reserve than inflation. They genuinely do not care about inflation at all. If they truly wanted to combat inflation, then they would have raised rates long ago and stopped printing money ad nauseum. It is important to remember that even small increases in interest rates have a large impact on this highly leveraged system. Raise rates leads to the cost of borrowing increasing. The Federal Reserve has two risks. 1. If the dollar remains strengthened too long, then the debt system comes undone. And 2. Is their ability to maintain dollar strength and dominance whilst this monetary tightening takes place, raising interest rates. This is what's in other countries paying in Chinese yuan or Russian ruble etc. is such an issue. They are battling this risk of rattling the debt market at the same time as risking a relatively or comparatively weaker dollar. The Federal Reserve during rate hikes will pay off short-term treasuries that are expiring over the next 2 years. We will get at least one more short-term hike of 50 basis points. The Fed's storyline: the Federal Reserve wants to lower demand to come into line with the lower supply in our economy. We have seen the lowest productivity figures in decades, hence a lower supply. Demand is still high, which is what the interest rates are aimed at addressing, according to the Fed. We are above 8% inflation and need to go down to 2%. In reality they do not care about inflation, just the relative strength of the dollar. These rate hikes will lower stocks over time, due to higher costs of borrowing, most likely leading to a cyclical bear market. Meaning we will recover, most likely after more stimulus. Interest rates increases impact the wealthy few directly, yet the indirect knock-on for the majority of the population is much worse. 90% of the stock markets is owned by 10% of the population. So why is this going to help the majority of citizens? To the morons at the Federal Reserve, newsflash assholes, IT won't. This will cause a hard landing in the stock market in September to October after pumping the markets one last time through more funding and fake relief efforts, under the guise of caring for the everyday citizen. As Powell is now no longer in fear of losing his tenure, he feels comfortable to say to us ahead of time that, it is not his fault when the economy crashes. He can continue to tighten in his pretend attempt to lower inflation. However, these ongoing emergency funds and emergencies themselves that they create, contradict their actions. Only increasing rates by 50 basis points, doesn't quell inflation. But once again, as we know, they're trying to remove inflation. They are only attempting to maintain the comparative strength of the dollar and have no interest in attempting to quell inflation. They in fact need inflation. This is how they are paying off their bad debt. Inflation helps them to make their short-term treasury payments. So now we know what is in store for us. What can we do? Well, value will flow into commodities, hard assets and crypto. Things that are needed, that have utility, that are a hedge on the ever-increasing inflation. All of the bombardment of fearful events is to distract from the ever-ongoing inflation that the Federal Reserve has caused. All the stocks that boomed were reliant on 0% rates. Look at the recent past presidents' stances on interest rates. They all helped to completely destroy the economy. All puppets. All commodities, food, metals, oil etc., and cryptocurrencies will boom as the Federal Reserve continues to allow inflation to remain well above the rates of interest. This will destroy class and over time, allow the implementation of a universal basic income.